Welcome to the Energy Desk, a weekly series from Mobius Risk Group analyzing the macro and fundamental trends shaping global energy markets. To take a closer look at any topics discussed on today's episode, head over to our research archive at research.mobiusriskgroup.com. Let's dive in. All right, we are sitting down here on April 11th. How's it going up in Montana here, Zane?
Bright and sunny this morning. The snow is melting as the energy markets are melting down.
The spring thaw. I think as we just discussed, there's plenty of topics for us to dig into, but I think maybe we'll start with the U.S.-China tariff trade battle that's going on. Looking at U.S. energy exports, one of the pieces that we put out this week on the research archive is what is the relationship between China and the U.S. for U.S. energy exports.
Yeah, I think it's a great list that you put together of just a, quick synopsis and maybe just, I guess, repeating what's been written, but stating here, like, how much of the U.S. energy exports are pointed at China. If you wouldn't mind, maybe just run down that list.
Yeah. So starting with crude and refined products. So China imported an average about 860,000 barrels a day from the U.S. in 2024. So what does that represent for the U.S.? That's about 8% of the U.S. total exports for crude and refined products. And that's down from 9.7% of U.S. energy exports in 2023. When we look at the feedstocks, this is really where you see China accounting for the largest share. So for ethane, China imports roughly 46% of the U.S.'s average daily exports of 492,000. So China gets 228,000 barrels a day of those. For propane, it's a little bit smaller. China's imports are about 18% of the U.S. average, so 1.8 million, 18% of that. And then LNG, you have about 5% of U.S. exports in 2024. And then coal for, metallurgical coal, we were looking at 15.8%. And then for steam coal, you have about 7%. So it varies quite a bit, but really looking at those feedstocks, petchem feedstocks, ethane being the big one. And, I think you had a data point on that is pretty interesting for the pricing side.
Yeah, when you go down that list of how prices have moved since this tariff war has become a real battle and not just something that was talked about, there were hints on Monday that there would be a 90-day pause. And then this Wednesday, or was it Tuesday? I guess it was Tuesday, became real, the pause. And
non-China,
and then we kick off this, China-U.S. tit for tat. So when you look at how the various, I'm just going to pick on the front month here, various commodities have moved. You've got the best performer of the bunch being ethane. It was trading about 29 cents a gallon, and it's down to 25 cents a gallon. And the worst of the bunch is propane. So they're in just the petchem stack. You've got propane that's down at like 19%. Not the front month necessarily, but when you look out the curve a little bit, which I think is a little bit more relevant, propane will have more of a tendency to have some curve shape than ethane will, which is more of a blocky, just kind of what is the price, and it holds there, and less of a contango or a backwardated shape. And crude kind of falls right there in the middle of the bunch. And I think that one of the interesting things to me is how much attention U.S. LNG trade has gotten relative to this U.S.-China trade war. This number that you just threw out there would say that, well, it's really not that significant. A very small portion of our U.S. LNG exports are pointed at China.
About half a B a day. So definitely have, I think, a lot of alternative buyers that would be willing to take that, especially looking at Europe, which we can talk about later. But that is pretty interesting.
Yeah. So, the general, I guess, theme for the market right now, is this a buying opportunity or a selling opportunity? Is, this confluence of the expectation and certainly equity markets, which have really been, I think, in our view, the biggest driver of what's pushed crude around. This idea that demand is going to falter materially, globally for sure, maybe even domestically as a result of all of these tariffs, which doesn't make a whole lot of sense to me. If we're, in theory, going to buy less from someone else because it costs more to get it here, then wouldn't we make more of it here? Now, you don't snap your fingers and do that overnight. Mm-hmm. But generally speaking, that idea that everywhere in the world will see lower demand is a bit vexing.
Yeah, I think it's pretty overblown, especially when you look at the number of countries that came to the negotiating table. While we don't have exact concrete numbers, the Trump administration throws around numbers like 75 of those nations came to negotiate. And as you said, they paused the reciprocal tariffs on those folks. And they still have a 10% baseline tariff across the board. But the fact that they're working towards potentially having more free trade agreements or different types of kind of a 0% to 0% type of tariff relationship. I think that is one element to pay attention to. And then the other part is just recognizing what does that mean for U.S. energy exports with all these other countries that have to bring their trade surplus down. And so you see that with Taiwan, you see that with South Korea, Vietnam, Japan. A lot of these folks are saying, hey, we'll come out and either, in Taiwan's case, we want to invest in the Alaska LNG project. Other Asia countries are mentioning that as well. But then just generally increasing your imports of, say, U.S. LNG, that I think more than offsets the impact from China. And then on the manufacturing front, to your point, I think the concept that I had, the takeaway that I have is that if there is any capacity to produce the good in the U.S. or with a friendly trade partner, then we can still do that. And it'll just increase demand for those folks. So,
yeah, I think it should just shift demand to different parts of the world.
Yeah.
And, so the demand side, the general theme is it's going to be lower is what the market is pricing as if. And then on the supply side, of course, right around the same time that all of the tariff excitement kicked off, you get OPEC not only sticking to their guns on Q2, but then up in the ante saying they're going to bring what was the July forecast forward to May. And the unknown is, well, where do they go from there? Does the higher, essentially 350,000 barrels a day more in May than was originally anticipated, does that then leave June from a higher starting point, meaning will we add another 140,000 barrels a day or so each month subsequent to that May step change? And, there's not really been any word on that. So, the idea that we're going to have too much supply, I think is honestly maybe more rational than too little demand. Mm-hmm. Just yesterday, the EIA's short-term energy outlook was released, and they made a pretty material cut to their 2025 demand expectation. They cut 2025 demand by about 500,000 barrels a day. It's down to 103.65 million barrels a day globally. And that compares to supply at 104.1 million barrels per day. Caveman's simplistic approach, more supply than demand equals looser market. There was, of course, as always, some pencil whipping of the past, so as to avoid any more confusion than we probably already create with all the numbers that we throw out on this podcast.
Yeah.
Last year, the EIA says that demand and supply were at parity. 102.75 million barrels a day. So you've got more supply coming than demand. All of that, a lot of that certainly hinges on OPEC's plans. And then there's the added wrinkle of what's coming up over the weekend. I guess Saturday, April 12th, there will be the first meeting in about a decade of a direct sit down between U.S. and Iranian officials. Certainly not talking heads of state here, but they're envoys, if you will. So I think there's, the potential for all kinds of excitement just coming in to next week. What happens in those discussions?
What I think is kind of an interesting tangent here is when you're talking about the short-term energy outlook and EIA saying we're at parity last year, how do you reconcile that with what we see in global inventories?
Well, that's not, so let's just say you go back late 23. Let me pull this up while we're talking on the fly here. Late 23, or actually let's pick the same point in time. Early April 23, we had crude stocks, that is, 460 million barrels on hand. Currently, we have 442. So we've got less crude on hand here. I guess the problem is like you've got these places where oil inventory is visible, really the US and Europe. You don't really know where the rest of the world is. There's a bunch of modeling and a bunch of guessing, and there are these OECD estimates come out with a 2-month lag. But in theory, like your point, like, well, wait a minute, like how do we have less crude than we did at some point further in the past? Well, if you look at that same, I guess, comparative point, like if you go back to April of 22, you've got 400 and, let's just call it 15 million barrels a day. So,
really above,
yeah. So there is some inventory improvement, but I think the point you're making is a good one in that, like, how do you reconcile it? Well, you don't. I mean, because you're trying to like extrapolate something about domestic inventory to the rest of the world. And, you can constantly go back and change the past. So, bolding that statement, we were highlighting it, bolding it. When you can change the past, when you can change what's already happened at will, how much confidence do you have in the future?
Yeah.
But from a narrative perspective, when you're lowering demand, forward demand expectations more than you're lowering supply. So, for example, yesterday's release lowered demand expectation by about 500,000 barrels a day for 25 and lowered the supply expectation by 100,000 barrels a day. And then in 25, closer to equal, but there was still a 650,000 barrel reduction in demand and about 500,000 barrel a day reduction in supply. So when you've got the narrative of there's going to be too much supply and too little demand, and then you get data points like this that come out, it keeps the market on its heels. Generally speaking, are we, headed for some doom where we must unequivocally turn off all incremental supply from the Western Hemisphere? Only OPEC knows. And I think that's a bigger kind of question mark of who is OPEC? Is OPEC against someone here? Is this, against Western powers and saying, hey, we've done our part for 2 years, curtailing all this production, your turn. There's one, possible storyline. But I think another is it OPEC versus OPEC? If you're the Saudis, are you just going to continually sit on the sidelines and let Kazakhstan, the UAE, Iraq, are you going to let all these people just continue to overproduce? Or do you just raise the bar and say, okay, here we go? The vast majority of these, planned production increases are from the Saudis, who have, understandably being given that by themselves as a de facto leader of OPEC, because they have carried the lion's share of the, I'll call it, market balancing supply curtailment for the last 2 years. Yeah. So a big unknown of is this really against someone? Do they truly believe that the world needs it, to your point on global inventories? But, it's going to be an interesting, I don't know, call it next 3 to 6 months on, do OPEC decisions change? Do these tariffs ever actually get implemented, or is this just a forever negotiation? I never read Art of the Deal, but it's got to be some half that book's probably exactly what we're doing right now.
Yeah, exactly. Yeah. I think one of the interesting ones is just seeing the kind of oil thread people on X having commentary about OPEC's decision. And it was interesting to see that a lot of the commentary was suggesting that OPEC would probably regret their decision. I think some of the other perspectives on that would be potentially creating some slack for supply impacts in the next couple of months. So you have maximum pressure campaign on Iran, like you mentioned, meeting this weekend between US and Iran, and really the question about the Iranian nuclear program and what that will eventually look like between nuclear weapons / just nuclear energy. I think background, they're enriching past the point of what you need for a nuclear reactor. I think everybody is kind of recognized that it's turning into the highest enrichment for the weapons grade. And then on the Venezuela side, potentially see some higher moves against, or larger moves against, the Maduro regime to try and get that under control for, all the election meddling type of stuff that we saw last year. And then, as you mentioned with Kazakhstan, have you seen the commentary this week, Russia and I think broader OPEC, talking to them? Did you have any thoughts on that?
Oh, I don't know. I guess show me, because people have been talking to the Kazakhs and the bigger companies that are, responsible for the production there. Yeah. So I guess, no, we mean it this time. It's like a little boy who cried wolf. I think they've meant it for the last 6 months. We're really going to reduce output. So it's hard to put a lot of stock in it. I think also there's that, final comment in the latest OPEC press release about this May change, that we're raising the bar and this will likely help those overproducing nations come in under
compensate.
Yeah, to compensate for their overproduction. So, the quota versus the actual, you don't know. You learn it month at a time. So I'm not too, I guess, confident that there will be some material change from Kazakhstan, which probably means that it will. They'll probably drop 500,000 barrels. I think that the point on slack, I still think it's critically important. I'm banging this drum again. Cutting Venezuelan production, with tariffs, I think there's this misconception that continually shows up. People will look at a chart of, say, Venezuelan or Iranian production, and they'll pick the low point and say, well, that's how far production could fall. In Venezuela's case, got down to 300,000 barrels a day, currently just under 1 million, or at least in the latest data point. So Venezuela could see 700,000 barrels a day of, production declines. That, to me, is an inaccurate assessment, because the low point was in 2020, when every nation in the world that produces oil found its, I'm going to call it, multi-year low point, for many decadal low point. In a place like the U.S. where you were, on this big growth trajectory because you had the new outlet of being allowed to export crude. The chart looks a little different. So honestly, right now at just under 1 million barrels a day, you're only about 300,000 barrels a day different than where Venezuelan production, or higher than where Venezuelan production was pre-2020 chaos. So let's say it's 300,000 from Venezuela. And then you go to Iran. Iran's oil production, and, I'm just going to kind of arbitrarily pick a point in the middle of 19. In the middle of 2019, 2.3 million barrels a day. Currently about 3.3. So 1 million barrels. So 1.3 million barrels a day is, I think, logically, without some global recession, which certainly equity market acted as if maybe that's where we're heading. But if you lose 1.3 million barrels a day, that's not really, it's kind of a drop in the bucket. When you look at just where OPEC's voluntary cut members are, currently projecting output will grow from, call it April to December, that's like 1.6 million barrels a day. Mm-hmm. So, you better take them all the way back down, or maybe there is too much supply, and that's leaving the U.S., Canada. I think at this point, certainly at these price levels, the odds that Mexico, Brazil, any of the other contributors in the Western Hemisphere see resilient oil production is pretty low. I would expect their output to continue to fall. Canada, a little bit of a question mark, with TMX and the outlet that they have to Asian markets. Probably best to assume that Canada at best would stay flat. And then that leaves the US, and the narrative that's repeated, everywhere literally is that $65 a barrel or lower, US production is going to decline. You don't really know. You'll pick up anecdotal stories about this company or that company laying down a rig. Before we got on, the question asked, like, how long does it take for US production to begin to decline? Well, it can in, say, a 2020 case, but that's a far lower price level than we currently are. It can fall in a matter of just a couple of months materially. I think realistically in a, call it mid-50s, mid-60s environment, it's probably rather slow, and it's not until 6 months out that you really see material reductions.
Yeah. I think the interesting one with the early return of the OPEC cuts in the context of potential supply impacts for Iran and Venezuela is, what is the market response if you have some meaningful supply impact when you're, trading at, say, $75, $80 a barrel versus a sub 60? I think the reaction from here is much more reasonable for broader economic impacts. So you're not going to have some major, upside inflation risks and variables like that, versus if you're, at $80 and you have a major supply impact before OPEC can bring that production back online, then, who knows what the reaction looks like. But then you get to the question of what happens to inflation when they're trying to bring inflation under control, especially with the tariffs, to try and just mitigate each of those risks to U.S. interest rates. Because I think the interest rate, so sovereign debt yield relationships, I think that's probably the biggest driver across all markets right now, because you have between the U.S. and China, this is another slight misconception, I think, in the market right now, is just what is the real risk of China's treasury holdings for the next several weeks of this trade war? What happens if they aggressively dump those? And in reality, while it is a risk to interest rates in the short term, that weapon for them is not a long-lived weapon. They have $760 billion in U.S. treasuries. That's the second largest among all nations, but it only represents about 2.5% of marketable U.S. debt. And so, to summarize that, it is a risk, but it is not something that they can just continue to do. It's about 30 days of aggressive dumping that they have. So I think that's probably a big question when you have, yields jumping up for the 10-year about 4.5% this week. So I don't know.
I mean, I would say we're in a state of confusion far and wide. I think, some of these like clarifying points on what does this data really mean? The headline grabbing statements versus the reality is going to be a very rocky road for the next 2 to 3 months, I think, for sure. And over that time, you get to see, all right, is global inventory moving in a bearish direction? Is it not? And then there's some supply side assumptions will be drawn from that. And then all the while, one of the biggest reasons for the kind of chaotic or, highly volatile environment that we seem likely to be in is the correlation to just kind of macroeconomic sentiment. If equity, just a couple of days ago, I mean, it was literally like, actually, I think it was yesterday, yesterday's daily changes, not that equity markets maybe really stopped, but everything was down 4%. I mean, literally one for one. I think Dow was the only one that was slightly outperformed at like down, minus 2.5%. So if equity markets recover, can they pull crude higher? Probably not as much as equity markets can pull crude lower, in my opinion, because there is this kind of separation. When we start going lower, it's yes, everything is down because everything is bad. But if equity markets start improving, there is going to be this, pesky little problem that is still out there in the, I guess, narrative of, but we've got supply coming and we don't know that there's more demand for oil. And in theory, that really fits well with the Trump administration's plan. You bring up inflation. I'll say inflation's got to be falling. Power's down, gas is down, gasoline is down. not relative to crude. And maybe there's another storyline, how products have traded, but everything's lower. So all of the energy impacts to inflation are certainly in reduction territory.
Yeah, I think that's another underappreciated one. We got some inflation numbers yesterday. So total CPI was down 0.1% month over month. And then core, so excluding energy, was 0.1% plus 0.1% month over month, which is a multi-year low. And so I think that is the other part, is that it's kind of this dance between the inflation and energy prices and managing the tariffs. So I think there is quite a bit of risk, but quite a bit of reward. On the Saudi Arabia question, I think one of the points that I'm curious to hear your thoughts on, is the quoted break-even fiscal oil price for Saudi Arabia at like $91 a barrel. What do you think the merit is for those types of IMF estimates?
Sorry, I'm always a little loose-lipped. Garbage. One of the lowest cost producers in the world. Like maybe on some 10-year time horizon, can they continue to reinvest? Probably not. But I don't know, in 2014, Saudis can't produce below $85 a barrel. Hold my beer and watch me produce at the same level for over a year at, $50, $60. So, it's not like the answer to that question, like what is the number? It gets a little bit misunderstood, and it's almost a shape of the curve discussion. So I'll say that in a perfect world, the Saudis would have month one trading $100 a barrel and month two trading 50. They can't do that. They can't manipulate the market in that way, no matter what decisions they make. They would want incredibly steep backwardation and have the long dated portions of a TI curve, a Brent curve, below the break-even cost for the rest of the world. Also a question mark. Because most of the world needs the long-dated tenors to be able to finance their ongoing exploration. Mm-hmm. I guess in some ways the same is true of the Saudis, but, clearly they've got an incredible amount that's just been, I guess, turned off. It was developed. It is available. How long till you exhaust that? Well, I don't know. How long, where is global demand? So I would say that just like the curtailments lasted longer than I believe most would have expected, so too can the return of barrels, which then you're right back to it doesn't matter really what anybody thinks of the Saudis, break-even cost. Whereas U.S. shales, and that is an impossible one to answer as well, because what U.S. shales break even is today, so the number is, currently believed to be $65 a barrel. If you go to 45 for very long, you're going to have a bunch of distressed asset sales, just like we did in 2016. The new buyers are going to take over and find some way to squeeze a little bit more juice out of the orange. Inflation, like we talked about, probably comes down. So your DNC costs and just your general financing costs are lower. And so 65 or 65 can turn into 60 or 55. Moving targets, all of them. I don't believe that at current price levels, there will be adequate supply to meet global demand for a, 2-year, 3-year time horizon. We'll have to price higher again. Yeah. My evidence for that more than anything is just the DUC inventory in the U.S. If our drilled but uncompleted wells are near decadal lows, you're going to have to spend more to drill more to have enough supply available. When you need it is just the question mark. And OPEC's in control. I mean, I don't know. OPEC, I think in some ways, you're welcome. I gave you 2 years of, $70 plus, not a lot over 70, but you're welcome. And, they get to decide, are we sub 70 in the U.S.? Are we, is there a chance to even peek our head over 80? I would say I doubt it in the near term, but they've been in control for 2 years and they're currently in control. And one might argue that they are always in control, because we also have our issue here. Sorry, I'm on a soapbox here. I got one more, for us to, if we grow production at all, where are we sending it to? We're sending it to the SPR, or we're sending it to some foreign market. We don't, any incremental production we have here doesn't really have a home here other than in the Strategic Petroleum Reserve, which then is another interesting question. Well, how much of a light sweet, mix do I want in my Strategic Petroleum Reserve? Like, that thing is there.
Yeah, it's mostly catered to Saudi Arabia and Iraqi grades anyway.
Right.
Yeah. Yeah. I think, that is kind of the interesting thread. And the other one that I think is just worth mentioning is, the price demand question as well. So as, prices come off, what happens to opportunistic buyers like China, for example, to take advantage of filling in some inventories and just kind of taking advantage of, sub 60 crude, which we haven't had for a while. And we saw them, as an opportunistic buyer, we saw that, I believe in 2022, 2023 had their record imports. So I don't know. I think that's another question because the price debate is also a factor in overall demand.
Well, and that's another interesting one because, the demand for oil is really just the demand for products. Mm-hmm. Oil only matters. The price of oil only really matters to the refiner. John Q. Public doesn't buy oil; they buy gasoline, they buy diesel. Currently, with the looking at the front of the curve, crack spreads for diesel and gasoline respectively, $25 and change, $22 and change. There's not much point in quoting the wholesale price because most people are going to have a hard time going, wait a minute, that's not what I paid. You don't get to buy wholesale unless you want to fill up your swimming pool. So the crack spreads at those levels are still pretty strong historically. So on this,
it's not much different than where they were a month ago.
If anything, they're a little stronger. I mean, just the past couple of days, they've backed off. And so it is an important thing to continue tracking. But on this big crude TI collapse, you actually saw crack spreads improve, meaning products did not move down as much as oil did. So that's the canary in the coal mine, in my opinion, always. What's crack spread behavior relative to, the market narrative of demand is strong, demand is weak? And in 2023 and 2024, we had there were enough out there that still kept banging the drum of demand is, going to be so strong. We're not going to have enough. Crack spreads were telling a different story. They were really quiet. I mean, there was a brief moment in spring 24 where the RBOB crack went parabolically higher, and it was kind of hard to reconcile the whole 2024 recap of gasoline inventory changes and price changes. I think is probably some, doorstop of a white paper that has a lot of Russian comments in there as they were turning the export of products on and off repeatedly. Mm-hmm. Yeah, I mean, I think we're hitting all the high points and maybe not drawing any clear conclusions other than expect volatility to remain elevated for the next several months as we're in this reshuffling of who gets what from where and at what price can people continue the flow of what we currently have today and certainly anymore.
Yeah. Where do you think Russia fits into all this? Because as the tariff stuff kicked off, the Russia, Ukraine, U.S. headlines kind of just sank into the background. So be interested to.
I'm going to acknowledge that I'm far from an expert on Russian crude production. I generally think of Russia, though, as more like, like Guyana or offshore projects in the U.S. Like once the plan is set, that money is spent. It's not a U.S. shale well that I drill it. Nope. 30 days later, nope, not drilling the next one. Mm-hmm. So in all along, there have not been, when you consider the amount of oil that Russia produces, over 9 million barrels, essentially pretty similar to the Saudis. So there have not been near the, changes in Russian production since the Ukraine, Russia war started. So the idea was all of the sanctions in 22 were going to cripple Russian production, and they didn't.
Yeah, so I rerouted them.
Yeah, I don't know. My thesis on Russia is probably not as meaningful as the laundry list of all the other countries we've already covered: Kazakhstan, UAE, Iraq, Iran, Venezuela, U.S., Canada. Mm-hmm. I think Russia will just quietly be in the background doing what they do and managing.
Incrementally moving barrels to Asia, or molecules in general to Asia and China.
Well, and you've seen, like, one of the interesting things lately is this kind of, I guess, I won't necessarily say shift, but doubling down, where European leaders are super pissed at Trump and all of his trade war efforts, and have vocally come out and said that we need to deepen our ties with China. I believe it's this summer. There's supposed to be some big summit with a bunch of European leaders and Xi Jinping. And, so how could that play out? That's a really fascinating one. It's that same thing. You just put a different sticker on the side of the barrel. So Russia may export even more crude to China, that Europe may end up becoming the buyer of, air quote, Chinese crude that's really Russian crude.
Yeah, or refined products from the...
Right.
Yeah, exactly. Yeah. I think the EU conversation, I think it was Spain that was potentially indicating that they wanted to explore more ties with China. I think that's definitely an interesting macro kind of decadal thread to, I guess, predict. I don't know if you have any forecasts for that, but just the relationship with the EU and the US with this type of trade negotiation really heating up. I don't know. I think China has benefited for a long time from being the, economy of scale for manufacturing for the world. And if they don't have buyers, that's a liability for China's manufacturing, especially after the property sector crisis over the last several years. But then if you have a fracturing in the EU-US relationship, I think that's an interesting question. But in reality, I think that the U.S. wallet is just more powerful than a lot of people are maybe acknowledging that it is, I should say, I guess.
Well, yeah, our wallet's infinite. You need some more money, you just print it. What's a debt?
Yeah.
Who cares?
Yeah. It'll be interesting to watch, and especially within the EU, what the fracturing within the bloc looks like. Yeah, and I guess staying briefly on that, for the U.S. LNG exports, one of the variables at hand is the EU gas inventories. Today, they came out and said that they plan to soften those gas storage rules before winter. This year, still kind of up in the air, but the stat for next year, it's looking like it's going to come through as a 10% deviation allowed from that November 1st target of 90% full. So it doesn't look like that will apply this year, but, do you have any takeaways for what Europe's current gas storage situation means for the U.S.?
I don't know. I think Europe does not like its people. Its leaders do not like their people. Shifting a plan to your refill plan, I think, is a pretty wild decision, made because prices were too high. When, European prices have fallen precipitously at the time that those discussions were first starting, the TTF curve, right? $15, $17 an MMBTU. Currently, you look out and the highest you get is about $11.50. I would say it's on sale, to go in less full, I think, is a really scary situation for Europe, at least for its citizenry. Hopefully I'm not making up a word there. I think that's a word. Their access to flowing supply diminished materially. And there's, I don't know, probably another podcast on Nord Stream. My short version is, I don't think it restarts before the end of next winter. Could it restart at some point? Yes. All right. We'll save the rest for another podcast. I guess the plan that Europe has for managing their energy needs feels like no plan at all. You've covered plenty of the nuke decisions. Maybe the best thing they got going is deepening ties with China, who certainly will have the ability to give all that Europe needs to buy, wants to buy, at a price, of course.
Yeah, it is. The part of that is strange to me is that the EU-US trade negotiations are all about the EU manufacturer. But then when the EU says, hey, we want to deepen ties with China, that is going to ruin your manufacturing sector, because right now you have, for Germany, automotives and high value manufacturing, precision manufacturing, pharmaceuticals. Those are your goods. Mm-hmm. That's what China is moving towards. EVs, pharmaceuticals, they've already done. So what is Europe going to produce? Are they just going to try and be the next consumer with 448 million people? Sure. How long does that last, though? Especially when you already are preparing for, or you have an ongoing industrial exodus that's been going for 5 years, but is accelerating now. And then, if the U.S. is saying, hey, tariffs are going to be in place for X, Y, and Z reasons, then I think European manufacturers also have to look and say, hey, when we have robotics, automation, artificial intelligence coming through the pipeline pretty quickly, the biggest question for manufacturing is just going to be the cost of your energy. And the U.S. has energy costs that are a fifth of Europe's. So that's, not even something that China can provide. So yeah, I think that it is just kind of a strange split between those relationships.
And man, can they change on a dime? Who knows?
Yeah.
Nothing like incredibly high prices, incredibly low prices to change relationships.
Yeah, exactly.
Who needs to?
Yeah. Well, I think we'll cut it there. Enough speculation for a Friday. Anything else you want to add?
One thing, I think we have to mention it because I have not written about it a lot yet. Micro comment about U.S. gas market as it ties to this broader discussion, which has been highly centered on global crude markets. The forward basis market out in little old West Texas, I say that loosely, of course, little old West Texas, probably one of the most important pieces of land in the world in terms of oil production right now. The basis market, Waha in West Texas, has seen an incredible rally in the past week. Late last week, it started to really move higher. And for some context, you had the May contract, the May Waha basis contract was at minus $4.15 early this month. And it is currently, or at least as of the April 10th, settles into minus $2.37. So almost a $2 improvement in the front month. You've got the Bow 25 strip that's moved in more than $1. And so why would this gas market in West Texas, this natural gas market in West Texas, move so materially higher? And one conclusion that can be drawn is that some of the oil producers out there that have sold forward NYMEX natural gas and forward Waha basis have said, well, I'm not going to produce as much oil, so I might as well buy back these hedges because that means I'm also not going to produce as much gas. We'll see if it holds and if it is a truism. It's also possible that, there could have been some specs that got, I guess, caught too short Waha basis. It feels to me like a market that is just far too risky for specs to hold a sizable position. And I think it was more producer driven. If you look at the Waha basis collapse, it was at a time that NYMEX was rallying, and for, more than a month, essentially for every penny that the NYMEX market went up, Waha went down. In other words, there was a fixed price level of about $1.50 an MMBTU that a Permian gas molecule was happy to be sold at. And then ultimately it moved near zero, meaning Waha was moving down faster than NYMEX was moving up, or I guess really I should say the NYMEX market was falling and Waha was falling too. But I think it's an interesting one. I think we'll keep coming back to where's Waha trading and what is it telling us? Like the two things for, at least U.S. oil production that I think we can lean on for evidence of whether the current price level, meaning say $55 to $60 a barrel, is having an impact, is where are the forwards and where are the daily markets for gas trading, and then what is the weekly DOE inventory. So I had to throw in one gas comment because I'm such a gas nerd.
Yeah, I mean, just a quick one on the managed money side of Waha basis is just an interesting, I don't know, how impactful, but shorts are significantly elevated, historically speaking, over the last 10 years. So right now, got about 18,000 contracts short, and that it's about 90th percentile looking back over the 10 years. So
maybe you just proved me wrong. Maybe it was all specs. Maybe somebody got a little crazy and said, let's do it. I'm making my year, or I'm retiring early. I'm going to get short Waha because who's going to get long it? And it worked until it didn't.
Yeah. Yeah. Well, sweet. Well, I think that's an interesting one. Plenty of stuff over the next couple of weeks that we'll be able to talk about, I'm sure.
Thanks for having me, Alex. As always, look forward to the next one.
All right. See you later, Zane. Thanks for joining us at The Energy Desk. Again, this is a limited series. So if you want to hear more episodes, you'll have to let us know by hitting follow wherever you get your podcasts or by sending me a message at amelvin@mobiusriskgroup.com. See you soon. And please keep in mind, this commentary contains our views and opinions and is based on information from sources we believe are reliable. This commentary is for informational purposes, should not be considered investment advice, and is not intended as an offer or solicitation with respect to the purchase and sale of commodity interests, or to serve as the basis for one to decide to execute derivatives or other transactions. This commentary is not considered promotional material.